the expenditure is very low. So we are targeting those types of cities only. And first of all, the market is very much unsegmented. It is very much unorganized. Very few organized players work in this segment. So lot of scope is there as compared if we talk about the market and the market potential. And if we talk about that product position, we are trying to position our product. You can say along with the leading products in this product, along with the leading brands. So we are quite hopeful that we may can increase our sales to at least 100 CR in the next 2 or maximum 2.5 years. We may ramp up our product line or production to that level, because the potential is there and the demand of the organized players versus there in the market. And lack of the organized player is giving us good opportunity to sell our product.
Okay, so this will be mainly for your current catchment areas of north states, or will you look to add a few other markets in other parts of the country?
No, we are right now for bath fittings, we are targeting Pan India. Right now focusing towards the nearby area of Bangalore plant, along with that eastern region and the northern region.
Okay. Sure, sir. Thank you, sir.
Thank you. The next question is from the line of Jaspreet Singh Arora from Equentis PMS. Please go ahead.
Yeah, hi. Thanks for the opportunity. Good afternoon, everyone. Just a quick, some clarifications and some specific questions. So, the 25% volume CAGR is over the next 3 years, while current year we're targeting a high double digit. Is that what's being given?
So what we are saying is that we will achieve 1,000 crore turnover by FY23. Okay, so that makes 35-40% revenue CAGR. This will be supported by high double digit volume growth.
High double digit. Okay, fair enough. And that's the 1,000 crore is March 23, fiscal year March 23.
I mean, assuming there is no third wave, etc. I mean, in the non-pandemic period, if we get the platform, this is achievable.
Sure. And the second thing is related to the capacity. So we go up from 118,000 to 125,000, next month. The Dadri brownfield would add more, right? Is that correct, or am I missing something?
No. So
debottlenecking or whatever is there. Yeah.
Dadri brownfield is like whatever has to happen, it has happened.
Okay.
Now we are sitting at 118,000 tons, and 7,000 tons will get added next month from Raipur.
Okay, and that is where we stop. And but there's also something mentioned regarding exploring more brownfield stock debottlenecking expansion opportunities over the next few quarters. Can you elaborate on that?
So of course, see, I mean, when we say that, the immediate target is 1,000 crore turnover, right? And then, I mean, as a company, we do believe in the industry space where we are, given the brand we would have built over the next 2 years, given the SKU portfolio addition, what would have happened over the next 2 years. So we do believe that 25-30% consistent revenue CAGR is possible. So for that, we will have to keep on doing some brownfield expansions, right? We will have to keep on adding new products to our portfolio.
Right.
So what we meant was that 20-25% of our EBITDA we should be spending on such capacity additions. And apart from that, West region is one market where we think we could add another plant, which right now we have in one in Gujarat. There could be something coming up in Maharashtra. That's what we believe.
Okay. So the volumes we've done last year was 47,000 plus, and now quarterly of 10,000 plus. So what is based on the current capacity, maybe at whatever you want to take, maybe 125 or 118,000, what is the maximum production possible in a fiscal year and in a particular quarter, whichever be the best quarter seasonally? Just trying to understand what's the best utilization is possible on a practical basis.
100,000 tons.
That's on an annual basis.
On an annual basis, on capacity of 125,000 tons.
Okay, and in a particular quarter, because there will be a lean and there will be a best quarter.
Yeah, so I think probably like Q4, which is good for both agri and building material.
Uh-huh.
So the skewness over there could be like 25 to 30,000 tons.
25 to 30,000. So we could go as much as 100% in a particular quarter if the demand allows.
Yes.
Roughly speaking. Okay. Fair enough. Was just trying to understand what's the, I mean, in 2 years' time, possibly that could be the exit run rate. Let's say you're talking March 23, maybe the March quarter of that year could be something closer to that. Just trying to understand.
I mean, if environment remains safe for the business, definitely.
Sure. Fair enough. Thank you so much, and all the best.
Yes, thanks.
Thank you. The next question is from the line of Ritesh Shah from Investec. Please go ahead.
Hi, thanks for the opportunity. Couple of questions. First is, you did indicate your comments on multi-gel. What we understand from the marketplace is the peer set is actually going for a different set of polyolefin set of fittings to cater to this large but typically a low price segment. So what are your thoughts over here, and do we have any, are you looking to venture into this segment to better tap into multi-gel as a theme?
See, again, I mean, the government schemes, I don't know if you noticed, like 4 or 5 years ago, there was this LED bulb scheme from the agency called EEL, right? They were selling LED bulb for 40 rupees. And all the major brands which are like spending hundreds of crores on their like ad spends every year, they participated for those orders. And the margin what they were making was 25 paisa for one LED bulb, right? So I guess I mean of course everyone wants to venture out with whatever comes from the government when it's new. Then people understand that what kind of margin return profile you are going to make. So I guess I mean same is here, right? So yes, there could be some opportunity for low price tab faucet, etc. But again, I mean when it's like on L1 ordering basis, right? It's very difficult to sustain the margin. I mean we are talking about margins in our tab business, tab faucet business, upward of 15-20%, right? Where we have appointed a Bollywood celebrity. We have a separate branding strategy to penetrate deeper into the markets. Rural market is one category where our sister company APL Apollo Tube has done so well with a product called Apollo Chocolate. Right, it was a steel door frame which replaced wooden door frames, and today we are selling 250,000 door frames every month. Okay, so I mean that's the power of your brand, of the distribution of your trade channels, right? So I mean as a company we have decided to focus on that, right? Yes, if there is any opportunity which is profitable, which is ROC accretive, definitely we'll go for that, right? We have our ears on the ground. So like in the earlier question, someone was asking that why are you not going into agri when there could be some space vacated? I mean, so we are having our ears on the ground, right? So if there is any opportunity which arises, we'll definitely go for it, right? But yeah, it has to be within our set benchmarks, right? Margins, ROC, and working capital.
Right. So if I have to just take a step back and understand multi-gel, you also indicated that the local companies are benefiting more. So if Apollo had to benefit, or the larger organized sector had to benefit out of this, how should one look at it? So is it a no-go zone, or is it we have a certain hurdle rate, only then we will actually go and do a bidding for a particular SKU or a particular order? So you indicated 15% plus margins on the tab business, which is lucrative. So is it something like it has to be minimum at the company, a blended level? How should one look at it?
Yeah, so number one, it's not a no-go zone. Okay, we are already selling our products in these projects. Okay, now we talk about hurdle rate. Hurdle rate, yes. I mean anything should be like at least high single-digit margin. Okay, for us to even evaluate any opportunity. And second, it shouldn't impact my collection days. See, I mean. It's been a very strong learning curve for us where our receivable days started coming down from 60 to 30, 40, right? And today we are very proud to tell you all the investors and analysts who are evaluating or who are looking at our stock that we are very proud to say that we are at a 30-40 day of receivable cycle, right? And we just don't want to deteriorate that to buy out some sales, right, from a government project, right? So I mean, hurdle rate, I mean, high single-digit margin, and my payment should be safe, right? I shouldn't be running around. See, I'm a brand company, I'm a trading company, I'm a marketing company, right, with a very strong manufacturing setup. So my job, the job for my salesman is to sell products, not to like beg for receivable collections. I hope this clarifies.
Yes, it helps. My second question is very basic. I just wanted to understand how do we account for the inventory. I think one of the statements that the management indicated that we do not expect inventory losses in Q2. Now, looking at where the PVC resin prices were, it actually came down by, I think, from 130 to 118, 119 rupees. And there has been a small bump of 2.5 rupees. So just wanted to understand, have we booked any inventory losses? If it has been booked, is it only on the resin part or it has also been booked on the finished goods? And what gives us comfort to say that we are not looking at inventory losses in Q2?
No, we never said that we are not looking at losses in Q2. We are in a business of buying PVC, right, converting that into a product brand, right, with a lead time of 30 days. So we will always carry that basic risk. The question is that how are we going to minimize that risk? How we are going to mitigate the risk? Okay. So first thing comes first is that you work on minimum low inventory levels, right? So that is one. Second is that you are able to revise your price list regularly, which is possible when you sell more and more value-added products, right? In commoditized products, the market acceptance is always weak, but in value-added products, it's always high, right? So that's how you mitigate the risk. Now in Q1, of course, there would be some marginal losses we would have booked, difficult to quantify. And in Q2 also, whatever the pricing fluctuation we might foresee, right, accordingly we will do that. But then what again I'm saying, on record from our side is that whatever fluctuation might come up, right, on annualized full year basis, sustainable margin is 13 to 15%. In one of the quarters, let's say PVC prices come down by 20 rupees, 30 rupees per kg. Then, one can imagine what kind of route it's going to have on all the PVC players, not only APL, not only Apollo pipes, right? So I guess, our job here sitting is that how do we ensure that we work on the sustainable 13-15% EBITDA margin. Yes, in 1 or 2 quarters, there could be plus minus here and there, but long-term margin is like how we are going ahead with our business plan.
Another, I completely appreciate from a strategy standpoint what you're indicating. Now, if I look at the inventory days on March end basis, it was 55 days. Now, just trying to understand how much would that be on June end basis? And have we already done a markdown on finished goods as well, or was it only done on the raw material or the resin inventory?
Yeah, actually, Riteshji, when we talk about the inventory at the closing of March, that inventory was we already anticipated the increase in the resin prices, and so because of that, we built our inventory in the first month of January only. We actually stopped all our purchases from next February. No bookings were made for the resin procurement plan from February onwards. So the loss on that account was a bit lower. We got lucky because we were selling very aggressively in April month, where the lockdown pressure was very minimum, and we were very aggressively selling our products in that month. May, of course, was disturbed because of lockdown and the pandemic. Again, it was coming back to normal in the month of June. So you can see the impact was there in the sales because of the drop in the month of June, you can say that. But we try to minimize that loss because of the high prices in April. We try to maintain gain maximum profit and minimize the loss of the same, you can say, within the same quarter. So exactly this happened like this, and because of that thing, you can say that we minimize our loss. Secondly, the resin is, you can say, not 100% of our sales. It is actually, you can say, if you take the total percentage, it is roughly around 40 to 50% of our sales. The balance is fitting grade where the drop is not so high and you can say margin doesn't drop too much over there and the gross margin was there. Along with that, CPVC, there was no drop at all. HDP, there was no drop at all. To put together, it was, you can say, maintainable because of water. And the slight drop was there in the quarter, which you can witness also because of that price drop.
This is very encouraging. Last question, if I may. Sir, we have seen PVC prices, or say piping product prices move in tandem with the resin prices. Now, given the shift which has happened from unorganized to organized, wherein the larger players are benefiting, I just wanted to understand, has the price increase which has been taken on fittings, say on a per kg basis, is it more than the price increases what we have seen typically on a UPVC pipe? I'm just trying to get some sense on the structural improvement in the margins given the shift in the market structure that we are looking at.
Yeah, of course, the margins increased in the fitting segment. Further, as you see that we are continuously increasing our SKUs. So the baseline SKUs are already there with us, and whatever the balance SKUs that we are building up in the last quarter and then in the coming quarters, these have high volume, high margins and the low volume. So the margins always improve with the sale of these goods. So there is always you can say high margin or high EBITDA level in these fittings as compared to pipes, where of course these players, big players or the regular players, they are trying to sell more quantity because of the dropping prices. The margins of course reduced, but we were very less focused on those products because of the low margin, and we are not too much, you can say, optimistic about those products. So our total focus was on the building products, where we were high sales, where the margins were not so much under pressure. Whereas of course in the agriculture product, the margins were under pressure, and you can say that the sales were a bit, you can say, a challenge because of the low margins. But we try to manage that thing. You can say with the help of fitting sales, high volume fitting sales.
Sure. Thank you so much for the detailed answers. Appreciate it.
Can we have the last question, please?
Sure, sir. We'll take the next question from the line of Pratik Agarwal from ITI Mutual Fund. Please go ahead.
Good afternoon, sir. Am I audible?
Please go ahead.
Sir, just a very basic question regarding PVC prices. For the last few months, it was understood that as the situation normalizes, the prices may come back to normal. But as we saw that didn't happen, and now we have understanding that things may not go back to the last year's level. It may settle somewhere in between. So what I'm asking is from the context of the 1,000 crore sales target FY2023. So we know that it is based on very high double-digit volume growth, as well as improvement in realization on the basis of value-added products and building material products. But my basic question was, how do you see the swing in the basic PVC prices, which may swing the top line? EBITDA margin may sustain and every profitability may sustain, but the optical 1,000 crores, how can it swing with if there is a drastic drop in PVC prices for whatever reason, and how do you see it, how much down it can go based on the industry dynamics? So that was my only question, sir.
So, when we say 1,000 crore, the basic assumption is 100,000 ton of sales volume at selling price of 100 rupees per kg. Right. So I think this should answer your question. Like if there is any swing plus minus, that's how it's going to impact us. Our business plan suggests 100,000 ton sales volume at realization of rupees 100 per kg.
Further regarding the PVC prices, if we talk about the PVC prices, they have not yet stabilized. The prices that was going downwards, that has now stopped, and it is now coming back to track. So you can see that the disruption in supply is still there. So it is not very easy right now to source PVC, and the premium we may see in the coming days again back to the previous level before COVID-2 level. The prices may go up to that level once again because of the shortage in the material and the supply problem still continuing with the product.
Understood, sir. Thanks a lot for answering that. Best wishes for my sake. Thank you.
Thank you.
Thank you. Ladies and gentlemen, due to time constraint, that was our last question. I now hand the conference over to Mr. Jigar Kamdar for his closing comments.
Yes, thank you. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would like to know more about the company, please feel free to contact our team. Thank you once again for taking the time out to join us on this call. Thank you and have a good day.
Thank you, participants and management of Apollo Pipes. Thank you.